Hey, this is Brian with the Short Sale Show, the show where we talk about how you can use the short sale process to avoid foreclosure, save your credit, and bring little to no money to closing. Now, we're going to drill down and talk a little bit more in detail about deficiency balances, negative amounts that result from short sales or foreclosures, exactly how that's handled, and how it can impact you. We talked about that in general, the three options that you're going to probably come across if you do face a short sale in our last episode. Feel free to go ahead and watch that one if you haven't, because it has the information is really pretty very pertinent to you and your situation. Right here, though, we're going to talk a little bit more in depth about how banks and mortgage insurance companies handle deficiency balances. One of the reasons why I know that this is going to be an important point to you is because there's a lot of confusion out there. In fact, there was this great piece on one of these other blogs. I kind of printed it up here for you. Obviously can't read it, so I'll put the link below this video so that you can go ahead and check it out. It's on the Business Week blog, which is called Hot Properties, and this particular post was posted by Peter Corey on June 12th, and it looks like a summary interview that he did with Alexander Pakin of he's the president and CEO of Option Next. So like I said, I'll go ahead and put a link to that in the show notes. If you're watching this on YouTube or one of the other video sites, then you are going to need to visit shortsaleshow.com to get that link. And this piece was pretty good. Alexander was talking about answering a lot of common questions, and I thought it had a lot of great information there. You may want to read it yourself if you're looking for info on this subject. There was a little bit of confusion, though, I thought, on this particular subject of how deficiency balances are handled. In fact, I pointed out that mortgage insurance and companies at times, sometimes, will pursue for deficiency balances themselves, which seems to be kind of a point of confusion. In fact, one of the other readers says that I was in error. Maybe I am, I don't know, but I don't think that I am, and we're going to go ahead and talk about why. See, here's the fact of the matter. Let's talk about foreclosures first. We'll back off of short sales and we'll talk about foreclosures. Let's say you walk away from your house and the bank has to take it back for foreclosure. Now, you may have mortgage insurance on your house if you have greater than 80% loan to value, and you were not doing like an 80-20 combo loan. So you may very well have mortgage insurance on your house. And when you pay your mortgage insurance premium, what it does is it really guarantees to your lender that, hey, you're saying I guarantee to make my payments on time. And if I don't make my payments on time and we go through foreclosure, then I'm going to go ahead and have this policy to protect my lender. They will reimburse for any negative amount that is absorbed. So that's the general idea there. So let's go through a typical scenario. Let's say you owe $200,000 on your house. You aren't able to make the payments, and you just choose for whatever reason not to pursue a short sale, not to pursue a short refinance or a deed in lieu, but are just going to go through the process and let the house go back to the bank. Bank takes the house back, and right now the house is only worth max $130,000, but because it's a foreclosure, the bank has to sell it less because everybody's got to get a great deal, right? The deal of the decade on a foreclosure, and they can only sell it for $115 after all their costs. They're walking away with, say, I don't know, $100,000. Negative amount there is $100,000, and the mortgage insurance company, let's say it might be, I don't know, MGIC, has to reimburse your mortgage company, which may be, let's just say, National City, that $100,000 or a portion thereof. I don't know exactly. Depends on how much your policy is set up to reimburse them for. So anyway, the question is, what's going to happen to this deficiency amount here, the negative $100,000? Can your mortgage insurance company go after you for it? Well, technically, it is a possibility, because let's back up and thinking about other type of insurance policies involving real estate, namely title insurance. So let's say you own a home and you sell your home to a buyer. We'll just call you Mr. Seller and that person Mr. Buyer. When you sell your property to Mr. Buyer, you are going to be giving them a warranty deed saying that you warrant that you guarantee that there are no title defects, no other claims to the property or any other liens. And the title insurance company pulls a chain of title at the Register of Deeds to make sure that there's nothing on there, that everything's been cured, and that you are basically able to warrant to the buyer, Mr. Buyer, that title is clear. Now, you give them the warranty deed, and you also give them a title insurance policy backed by the title insurance company saying, hey, yeah, I promise that the title is clear on this property, there's no other liens or outstanding judgments against it, and I'm going to give you this title insurance policy. So even if something did come up, like back from 1891 or something, that the Cowboy Joe owned the property and his family technically still owes it, God only knows what. But I'm going to give you a title insurance policy guaranteeing it, so you, Mr. Buyer, don't have to worry that somebody's going to show up and knock on your door and say, hey, this house is mine. You don't own this house, I own this house, right? And but let's say that you kind of left out the fact that you were, I brought this up as an example, you were starting a business and you borrowed $75,000 from your auntie. So auntie gives you $75,000, but that's a lot of money. So she requires you to sign over a quitclaim deed for 75% of your home in order for her to give that to you. And once you pay the loan back, she'll quitclaim back to you, right? Well, auntie, thinking that's all in the family, doesn't go and record that deed. Now you, Mr. Seller, sell the house to Mr. Buyer, conveniently forget that you put this out there, and it doesn't show up on the title report, so title insurance company doesn't know, and then you warrant that this property is free of all title defects and is cleared. Auntie, however, gets mad when things don't go so good because you're part of the troubled economy and business ain't going so well and you're not paying auntie back. She looks to go get the house in order to cover her $75,000 that she loaned you, and lo and behold, you sold it to somebody else. She says, hey, that's not your house, that's my house. And the buyer says, oh my God. And then they remember, oh, thank you, Jesus, I got a title insurance policy covering me, right? Good. So they go ahead and then they say, you know what? Title insurance policy goes ahead and pays off auntie, gets her $75,000. Do you think that that's all kind and good and everything's pretty much kosher? Oh no. Title insurance policy the title insurance company is coming after you, Mr. Seller, because you broke your promise. You promised that there was no title defects when in fact there was. Title insurance company, I guarantee, will sue you for breaking that promise and come after you for that $75,000. Question might be raised, hey, what was I paying for the policy for? But still, that's the fact of the matter. Fast forward to mortgage insurance, okay? You promised to make payments on your mortgage. In this case, we were saying to National City. You didn't. You broke your promise. Property went into foreclosure. And so at that point in time, the mortgage insurance company had to take a loss and kick money back to National City because you broke your promise and they were the company. Do you think in that situation, when you broke your promise, that the mortgage insurance company has a right to come back at you for the amount of the loss? Yes, they do. Is it common? Actually, no, it is not. Reason being is you probably are not going to be able to pay on any type of deficiency judgment. It's difficult for them to get them, but sometimes they do pursue them. We can go ahead and give you some examples, but I really don't have time because we're running out of time in this particular video. Simple fact of the matter, though, is that in a short sale scenario or a foreclosure scenario, a deed in lieu scenario, or a short refi scenario, what the mortgage insurance company has to say is pretty much on par with what the actual mortgage company has to say concerning that particular sale transaction, whatever you want to call it. So you very well often will have to get clearance from the mortgage insurance company before they will allow a short sale to go through. Sometimes they will require you, as we said in method number 3, to reassume a portion of the debt. How do I know this? Because I got 2 of them right now where that happened. Both of them were with Radian. The other companies don't tend to do this so much, but if you have Radian as a mortgage insurance company, you can just about guarantee they're going to require you to do the hybrid scenario like we talked about in the last episode, where you have to reassume a portion of that debt. Usually it's a very small portion, anywhere from 10 to 25% of whatever the negative amount is. They usually transform it into 0% interest and have you pay it off anywhere from 5 to 10 years. Usually not a bad deal when you think about it. Do that versus foreclosure, not a bad idea. All of my sellers that have been presented with this particular scenario, go ahead and accept it. Now, let me make the point. When you sign the promissory note on these types of deals, are signing a promissory note to the mortgage insurance company, not the mortgage company. Why is that? Because the mortgage insurance company has just as much of a claim and a stake in what happens to your property in a short sale, short refi, deed in lieu, or foreclosure as you or as the original mortgage company does. Hope that clarifies some of the questions and answers. If you have more questions, put it in the comments below on the short sale show post. And if you feel that this helped you out, go ahead and broadcast it to the world. Click some of the buttons like the Stumble Upon, the Dig, the Technorati, and let everybody know about this resource if you thought it was helpful in clearing up some questions in your mind. Thanks again for watching the Short Sale Show, and I'm Brian Kurtz.